It's time now for today's strategy session. It's a survey, and we're watching a survey of C-suite executives that shows that corporate confidence is falling. The chart here shows what CEOs expect the economy to be like 1 year from now. It's down to levels not seen in years as investors brace for the fallout from President Trump's tariff policies. Let's get the view from inside the C-suite and bring in Scott Sperling, THL Partners co-CEO. Scott, thank you for joining us.
You're very welcome.
There's been a lot of talk about sentiment right now, both among consumers and among CEOs. You guys have a broad swath of companies in your portfolio from different types of industries. How's everybody feeling right now?
Well, I think uncertainty is the word of the day, the week, and the month. We came out of, I would say, almost a euphoric set of feelings because of very strong fourth quarter performance. I think there's continues to be a lot of excitement about deregulation and many of the other policies of this administration. The uncertainty is really centered on the issue we've all been talking about, which is what is the impact on the cost structure of a wide range of businesses from the tariff policy that we're going to hear a lot more about today. But I suspect that this is just the beginning, that there is going to be a lot of changes over the course of not just the next 30 days, but probably over many, many months. And it's those levels of uncertainty that I think is causing the confidence to sink that you see. And also, if you think about it from a consumer's perspective, you read a lot, you hear a lot about the fact that these tariffs may be causing significant consumer level inflation. And so I think it's translating into a set of very hard to read numbers coming out of the consumer spending set of metrics, where you might see some significant bumps up as people try to buy in advance of what they view will be an highly inflated set of prices down the road. But consumer confidence continues to be somewhat shaky as well.
Scott, something that you mentioned is that there is still this thought that deregulation is coming and will be helpful. Tax cut extension is still coming and will be helpful. Why is that view intact, given the messiness of this tariff situation and the seeming indifference that the president has expressed about the costs that are clearly being incurred from that strategy?
Yeah. Well, I think that the fact that he has expressed what you've called indifference, which I think is an indifference to the very short-term moves in the market, which that is unusual for him. That is not something that I think people typically
but it doesn't even
believe that he does.
If I may, it doesn't even seem to be just about the short-term moves in the market.
Well, I do think.
Sorry.
I was just going to say, I do think that they are trying to articulate the fact that there will be significant positive outcomes from having a set of tariff policies that they believe will both level playing fields, but also drive significant private sector investment back into the United States and allow them, many of them have been articulating the thought that some level of permanent tariff is a good substitute for taking money out of the pockets of business and individuals through the typical tax code. And that if they can do that, they can take dollars from the government that are relatively inefficient and put it back into the private sector. That I think is a theory that many of them have latched onto, but not everyone in the administration. So I think we're still seeing the struggle between people who believe tariffs should be a short-term negotiating strategy to level a playing field, and those that believe a permanent tariff of some level is structurally a better answer than higher taxes.
And to some degree, we're already seeing evidence that things are different this time around. We have news of China blocking off investments into the United States, for example,
Yes.
Potentially allies abroad teaming up against the U.S. To what extent is that a headwind that you are concerned about?
Well, I do think that there's been national security concerns about Chinese investment in the United States for a while, so the level has not been significant. So I'm not sure that when you kind of look through the numbers is that significant. But I think it is a signaling that the Chinese are sending about the way that they might respond to this. And I think we all know that the Chinese are highly vulnerable to this policy because we are their biggest market. And they do depend on exports as the key driver of their economic health. And so if anyone is going to be adversely affected in a scaled way, it will be the Chinese. Now, there are lots of reasons to believe that there are going to be a lot of mistakes made as they implement this policy. We've probably already seen the back and forths about the righteousness of the tariffs with Canada, for example, and what the policies are with Mexico. So I think that we're going to have to wait quite a while to see whatever the longer term, more stable set of policies from a tariff perspective. And that means continued uncertainty.
So how do you invest in that environment then, Scott, if uncertainty is
very
the only
carefully,
certainty?
very carefully. I think you have to look at the fact that this may be a very difficult year. I am hearing from CEOs across a wide range of industries, mostly friends of mine, of larger companies, that revenues were okay for the first quarter, but bookings are really difficult, which means that as you look forward, this is probably going to be a more difficult year than anyone assessed coming into the year, and that analyst revisions are more likely to be down than they will be to be up. Companies have to figure out how they're going to respond to what may be higher input costs that they're not going to be able to work through in terms of the margin structure of their business as it currently exists. So they have to figure out, how do we get more productivity, how they change supply chains, and what and how much they can pass on to customers. You're already seeing some of the stories about Walmart really pushing back on their Chinese suppliers, even though the Chinese government has threatened them about this. But Walmart basically saying, you're going to give me a 10% cut, or we're just not going to buy from you. So we're going to see how much can be absorbed outside of the U.S. consumer and how much is going to come back both to the U.S. consumer, but also to businesses, because a lot of tariffs may affect intermediate goods or inputs like aluminum and steel that cross so many different kinds of business to business and business to consumer manufacturers and providers.
Scott, how is all of this translating to what you are doing in your business? Are you holding off on sort of aggressively looking for acquisitions right now? Or because prices have fallen, is it a good time? Or are you more focused on sort of the management of your existing portfolio and riding out this period?
The sectors we invest in, healthcare technology and financial technologies and services, tend to be less directly affected by the tariffs, but obviously our customers could be affected. So, we're looking through to that. We have invested, and I think a lot of people in our industry have been looking to invest in companies that actually help this customers drive higher productivity. So we're looking at technologies and services that can help offset the negative impact of tariffs, higher tariffs, to a lot of our customers. Now, that doesn't mean there won't be bumpiness, and it doesn't mean that CapEx isn't going to get affected. And in fact, in many ways, it may be frozen for a while. We haven't heard of things going away or being canceled, but there's certainly more caution on the part of lots of businesses for all the reasons we've been discussing. And that translates into perhaps waiting a bit or holding back on exactly where they're going to be investing in infrastructure and other forms of CapEx. But the one area that we think that there's going to continue to be significant demand will be for those things that help the productivity of their cost structure. And so things like automation, software, and things related to the ability of generative AI to provide automation for things that we haven't historically automated. Those we believe are quite good areas. Lots of choppiness in life science because of everything that we've read about. But we do think that is one of the industries that has made America great. It has been one of the most important industries for the United States. We believe that when the administration fully looks at it, there is going to be a set of perhaps maybe I could call it corrections to some of the early pronouncements about what they're doing in terms of the funding of research, because it is such an important industry for the United States, for the people of the United States, and globally. But it happens to be an area that is very large that we tend to be the dominant player in.
Yeah.
So we think that'll be recognized.